What's up, guys? Welcome to my channel and welcome to another video. In today's video, I'm going to be going over my top 4 growth ETFs to buy for the second half of 2023. A growth ETF is an investment fund that focuses on investing in companies that have high potential for growth. A growth ETF specifically targets companies that are expected to have above average growth in earnings and share prices. By investing in ETFs, you gain exposure to a portfolio of growth-oriented stocks without the need to buy individual stocks. Now, however, I will point out that ETFs do fluctuate with market conditions, and there's no guarantee that you will see positive returns when investing in ETFs, specifically in the short term. So whenever I'm investing, I'm looking at a 10 to 20 year investment period where I'm investing in these funds that I mentioned every month, a defined amount for the next 10 to 20 years. And when I retire, I'm banking on being able to realize the average returns of the stock market, which of today is anywhere between 7 to 10% return. I specifically tell newer investors that ETFs is where they should start, because if you're not a seasoned investor or you don't have a lot of time to research stocks and research companies and look at their 10K reports and look at their earnings, ETFs are the way to go, because you invest in a fund, and when you invest in that fund, it has tons of different stocks in that fund, which takes out the need for you to research tons of individual stocks. Now, I will say that you'll want to research the fund itself, but that's much easier than going in and that's much easier process than going in and reviewing and combing through hundreds of different stocks to try to find a stock that you want to invest in. So I often give the grocery store aisle analogy when describing ETFs, not just the growth ETFs that we'll be discussing in this video, but ETFs in general. So the grocery store analogy is basically you walk down a cereal aisle and you have Captain Crunch, you've got Fruity Pebbles, you've got shredded wheat, you've got Bran Flakes, you've got Cheerios, you've got Honey Nut Cheerios, you've got all of these different brands of cereal in this aisle. And if you think of the individual boxes of cereal as stocks, the ETF would be the entire aisle. So you go down that aisle, you buy the ETF, and you're going down that aisle, and you're basically buying a little bit of each item in that aisle, and it allows you to diversify your portfolio while not having to focus on picking an individual stock. It takes you out of the chair of being the stock picking expert, and it puts it in the hands of the fund managers who do this every day. Let them be the expert, and you just pick the fund. So in my opinion, I think now is one of the best times to start investing in the stock market, especially if you're new and you have no experience in investing. The markets are right, I think, in the middle where we're trying to decide whether or not we're ready to go on that next bull run and stocks moving to the upside. But any negative news that hits the market, such as inflation or interest rates being increased, that could cause the market to actually dip back down again. So we're kind of the market's kind of in limbo right now from my perspective. But you still have a lot of A-plus blue chip companies out there that you can still buy for what I would consider a discount based on where they were trading at 2 years ago or even 18 months ago. So if you can get in and you can actually start buying some of these growth ETFs now, these ETFs include all the stocks that have that huge growth potential that can explode once the market comes out of, I guess, what we're going to call a recession. I don't know if people want to consider it a recession, but once we get back on that bull market and we start moving to the upside, these growth ETFs are going to explode. And before we dive into my top 4 growth ETFs to invest in for the rest of 2023, I do want to note that the ETFs that I'm going to be covering are meant for informational purposes only and should not be considered investment advice. Number 4 on the list is Schwab's US Large Cap Growth ETF. This ETF is linked to the Dow Jones US Large Cap Growth Total Stock Market Index, which offers exposure to large cap companies within the growth sector of the US equity market. This fund includes roughly 500 holdings, and a large portion of the fund's holdings are tilted towards technology, while sectors such as industrials, consumer goods, energy, and healthcare all receive equal weighting. The fund has a super low expense ratio of 0.04%, meaning that if you had $10,000 invested in this fund, it would cost you $4. Over the last 1 year, this fund has returned 16.82%, and year to date, from January 2023, this fund has a return of 24.06%. And its top 15 holdings include Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, United Health Group, Visa, Eli Lilly, MasterCard, Broadcom, Costco, and Salesforce. This is a great collection of growth companies in this ETF, and this would be a great addition to your portfolio to add this ETF. Number 3 on the list is a Consumer Discretionary Select Sector SPDR fund. This ETF offers exposure to consumer discretionary sector, making it an appealing option for investors looking to implement a sector rotation strategy or tilt exposure towards corners of the U.S. market that may perform well during a recovery. XLY offers impressive liquidity, cost efficiency, and depth of exposure, making it one of the best ETFs that you can invest in the consumer discretionary sector. This ETF also has a very low expense ratio of 0.10%, meaning if you had $10,000 invested in this fund, it would cost you $10. And from a performance perspective, this fund has a 1-year return of 8.12%, and a year to date, from January 2023 until today, has a return of 18.68%. And its top 15 holdings are Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Starbucks, Booking, TJX, O'Reilly Automotive, Chipotle Mexican Grill, AutoZone, Marriott, General Motors, and Ford Motor Company. Number 2 on the list is iShares Russell 1000 Growth ETF. This ETF tracks the Russell 1000 Growth Index, which offers exposure to large cap companies within the growth sector of the U.S. equity market. This ETF is linked to an index that has a little over 600 holdings and is heavily weighted towards technology, while the remaining sectors within this fund are equally weighted. This ETF also has a low expense ratio of 0.18%, meaning if you had $10,000 invested in this fund, it would cost $18. The fund had a 1-year return of 14.76% and a year-to-date return of 19.44%. And its top 15 holdings is Apple, Microsoft, Amazon, Nvidia, Google, Tesla, United Health Group, Visa, MasterCard, Eli Lilly, Broadcom, AbbVie, Pepsi, and Costco. As you can see, this fund consists of a large amount of top blue chip companies that have a long history of growth and financial stability, making this one of the top funds that you can invest in. And the number 1 growth index fund on my list is Vanguard's Growth ETF. This ETF is linked to the MSCI US Prime Market Growth Index and offers exposure to large cap companies within the growth sector of the US equity market. This ETF is linked to an index with a little over 400 companies and is heavily weighted towards technology, with the remaining sectors being equally weighted. This ETF has an expense ratio of 0.04%, meaning if you had $10,000 invested in the fund, it would cost a total of $4. The fund has a 1-year return of 14.92% and a year-to-date return of 22.94%, and its top 15 holdings include Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Visa, Eli Lilly, MasterCard, Home Depot, Meta, Costco, McDonald's, and Thermo Fisher. All right, that's it. My top 4 growth ETFs to invest in for the remainder of 2023. Now, there is some overlap with some of the funds that I went over in today's video. But the beauty of investing in ETFs is you don't have to buy a lot of them in order to have wide diversification across the market. You can invest in something such as Vanguard's Growth ETF, and that will give you exposure to the entire growth sector within that index and heavily tilted towards technology. If you'd like to invest in something else, you could pick something like XLY, which is heavily weighted towards consumer discretionary. So you'll have to decide how you want to put your portfolio together. But the great thing is an ETF gives you that wide exposure so you don't have to pick individual stocks. If you got some value from this video, I'd really appreciate a like and subscribe, and comment down below some of the ETFs, the growth ETFs that you like, or ones that you'd like to see me cover in a future video. Thanks, and I'll see you in the next video.